Uber stock has been on a wild ride, rising almost 200% in the past 5 years. Today, Uber is worth more than Delta Airlines, BMW and Shopify combined. In this video, we're diving into one of the most exciting turnaround stories in tech to see why Uber is my top stock pick for 2025. During the video, I'll give you my fair value price to see if the stock is priced at a discount or a premium versus its current share price of roughly $84. Plus, I'll give you my buy, sell and hold recommendation and the final star rating of the stock as well. And to get there, we'll walk through 4 sections. But let's start with a brief intro to Uber as a company and see what makes it so unique. So let's start off by looking at a few key numbers over the past year for Uber. We can see that revenue and EBITDA has grown nicely, and the company has currently an EBITDA margin of 12%. We can see that the current share price has risen 22% over the past year, and that the company of course is headquartered in the United States in San Francisco. So Uber is a global technology platform, best known for ride sharing, but today the company is much more than just hailing a ride. Uber operates across 2 major segments. We have mobility, this includes ride sharing, we have scooters, public transport integrations, and basically anything that moves people. And then we have delivery. With Uber Eats, the company dominates food, groceries, and even retail delivery in many key markets. The company's strength comes from network effects. More riders attract more drivers means lower wait times, and lower wait times attract even more riders. But Uber's story is no longer just about growth, it's about profitability. For the first time, Uber is consistently profitable and generating strong free cash flow, which is a complete reversal from its early years of huge losses. So in reality, the bull case for Uber is quite simple. We have a massive total addressable market across mobility and delivery across the world. We have strong network effects that make it hard for competitors to catch up. And we have operating leverage. As the platform scales, profit margins keep expanding. But of course, there are a few risks. We have, for instance, regulation, especially with labor laws. The big one is autonomous vehicles. If you believe that another company, such as a car maker, could compete with Uber with their own autonomous vehicles, then that's of course a risk. And also in economic downturns, that could hurt discretionary spending and the number of rides and deliveries that people want and need. Okay, so now we have a sense of what Uber does as a company. We'll go through some of the factors for the bull and the bear case. Let's move on to the second part and look at some historical financial data of the company. Let's start off with the core financial performance, and here we can see a few things. We can see that the revenue here in blue has grown consistently in the past 5 years, but we can also see, of course, that the EBITDA in green has finally become positive, right? The company is finally profitable. We can also see that reflected in the EBITDA margin, which is currently 12% for 2024. And we can see the growth rates. We can see that revenue has grown by 41% each year over the past 5 years. Let's also look at the debt sustainability within the company and see if debt itself is a risk for us as investors. Here we can see that the debt in purple has been quite flat over the past 4 years at least, growing at 4% per year, while the excess cash has grown at 7% per year. Now, the important key takeaway here is the debt to EBITDA ratio. That shows us how much EBITDA we need to pay down the company's debt minus any excess cash, of course. And we can see that that ratio is at 0.5 times today, which is quite low. We're targeting below 3 times, so 0.5 is well within our target range. Another interesting chart to look at has to do with the enterprise value performance of the company. Now, the enterprise value is the market cap, which is the total value of the shares, plus any debt minus any excess cash. Now, the logic here is that if you have to buy a company, you have to at some point pay down the debt. So we add that to the total market cap, and you could in essence use the excess cash within the company to do that. So that's why we're removing the excess cash. And here we can see a few things. We can see that the enterprise value has risen in the past 3 years, but the important key takeaway has to do with the enterprise value relative to the EBITDA, which is of course a ratio. And we can see it's no longer within this crazy 240 times. Today it's just 29 times, which is much more reasonable for investors buying the company today. Let's also take a look at the free cash flow performance within the company. And here we can see the exact same story as we saw with the EBITDA. We can see that the revenue is growing consistently each year and that the free cash flow in green is finally positive. This is now a profitable company. Now, the important key takeaway here is the free cash flow margin. See how it's expanding each year, and currently it's at 11%, which is showing us that the company is becoming much more profitable relative to the revenue that it produces each year. Here we have also the free cash flow performance, but on a per share basis, and we can see the same story, right? It was negative back in 2020, and then today finally the company is positive on a free cash flow per share basis. We can also see this in the free cash flow yield, right? It has gone up quite steadily in the past 2 or 3 years, and in 2024 it reached 3.2%, which is quite healthy. In the final chart, let's look at the share performance of the company. We can see that the average share price has risen quite sharply in the past 3 years, ever since the market dipped in 2022. But we can also see that the number of shares in the company has risen quite sharply. That's represented in blue. So this means that the company, or Uber, is diluting its shareholders by on average 5.3% per year, which isn't great. I assume this has to do with the company having issues with profitability in the past, and I expect the dilution to go down as the company becomes much more profitable in the future. Okay, so now we're going through some historical data that we have of Uber. Let's look at 2 price targets that we need before looking at the final valuation later on. So let's start off with the enterprise value price target. So for these price targets, I'm looking at a few key assumptions all the way up to 2034. So the first one has to do with revenue growth. I'm assuming 12% per average. I think that's quite conservative, especially as the company has grown revenues at 41% on average over the past 5 years. Now, in terms of EBITDA margin in 2034, this is really where the magic happens. As you remember, the company had 12% in 2024. I'm assuming 25% EBITDA margin as the company is becoming much more profitable with time. Now, in terms of relative valuation to its EBITDA, which is the enterprise value to EBITDA ratio, I'm assuming 25 times, which is slightly lower than today's 29 times. I think that's reasonable, especially considering 12% growth and an EBITDA margin of 25%. And with all of those assumptions, we get an enterprise value price target in 2034 of roughly $260. Now let's also give the company a free cash flow price target all the way up to 2034, and I'll show you later why we need these price targets. So the first assumption I have for this is that I'm assuming 14% average year-over-year free cash flow growth. That's higher than the revenue growth at 12%, assuming that the company is becoming much more profitable. Now, I'll also set the free cash flow yield at 3.5%, slightly higher than the past year, and also I've reduced the yearly share dilution to 3% versus the 5% we've seen in the past 5 years. Now, with those assumptions in mind, we get a free cash flow price target of roughly $220 in 2034. So as we have 2 price targets until 2034 for Uber, let's just weigh them equally, and then we get a weighted price target of $240 per share. Now we need this price target to know at what price we'll sell the stock in 10 years time to essentially estimate the expected annual return we could get from Uber stock in the coming 10 years. We've now looked at some historical data that we have of Uber, and we've given the company a weighted price target. Let's move on to the exciting part, which is, of course, the stock valuation. So if we discount all the future cash flows that we're estimating for Uber stock in the coming 10 years, we get a fair share price of today of roughly $145. And that's a discount of 42% versus its current share price. This also implies an annual expected compounded return of 17% per year, which is quite strong. That's stronger than the market average at roughly 8 to 10% per year. And this shows us the beauty of this opportunity. We have a company that we're only estimating to grow revenues at 12%, yet we as investors get 17% return on average per year thanks to increased profitability and better margins in the coming years. Now, I'm assuming that the revenue and the free cash flow will both grow consistently in the coming 10 years. The big takeaway here is that I applied a high growth rate for the free cash flow in the first few years, as you can see here with the green dotted line, assuming that the company will continue to increase its profitability. And we can see this all the way up to 2029, where both growth rates for free cash flow and revenue essentially become the same all the way up to 2034. So now I have a fair share price of Uber stock. Let's give the company a final star rating as well. So my final recommendation, as you might have expected by now, is a strong buy for Uber, and I've given the company 5 out of 5 stars. And here we can see that I've given the company essentially a perfect score across most categories. We see strong revenue, strong EBITDA, strong free cash flow growth as well, and low debt. On top of that, we have a great valuation, we have strong competitive positioning, and a strong brand and reputation. Where the company has not scored that well has to do with two categories. We have consistent stock performance, that's not really been the case in the past 5 years, hopefully that improves, and also in terms of low legal and macro risks. Now this has to do with mainly two things. One, if an economic downturn happens, that might hit Uber's numbers, as well as the threat of autonomous vehicles and how that will shape out in the future as well. Thank you so much for watching. Please write in the comments below, is there any other stock you'd like me to value next? And if you want the free one-pager, please go down to the link in the description and you get all the data I've used in this model here. So yeah, thanks so much. Please like and subscribe, and I'll see you in the next one.